This is the second episode. The first one we talked about various issues economically and financially that are facing banks. And what we want to do in this episode is to talk about what the banks may do in response. But before I jump into the agenda, I'd like each of my co-hosts to introduce themselves. I'll start with myself. I'm Tom Abraham. I spent 35 plus years in the capital markets, half of that outside the United States. I've worked for firms such as Citibank and Deutsche Bank, originally Accenture Consulting, so I have that background. And most recently with a company called DST in the software business, servicing both the buy side and sell side. So, Ethan?
Hi, Ethan Heisler, CFA. I'm the editor-in-chief of the Bank Treasury newsletter, which this month is celebrating its 20th year in operation. My dialogue is with bank treasurers and other members of the participants in the fixed income markets. Topics that I generally talk about: Fed, what bank treasurers are trying to do to manage the asset liability issues that come up on their balance sheet. And I've been in the industry for 43 years.
Thank you very much. Murad Chowdhury, BTRM associated with the last 10 years, also a bank NED and author of the odd textbook or two. Ethan, you forgot to say that, well, I'm going to say it, you had a stellar career, 43 years. Gosh, I thought I was 30, that's even longer than me, 35 years. Now, you forgot to say that amongst the, you're an alumnus of the US Federal Reserve and Salomon Brothers. Now, with that kind of background, the BTRM is honored to have you taking part in this conversation with us. Back to you, Mr. Abraham.
All right, thank you. What I want to do is open with some comments about where we've been, or where the banks have been, and what they face today, and then we'll move on to what they ought to do. And at that point, I'll invite both Ethan and Murad to answer a series of questions I've put together. But let me start off by kind of talking about where we've been and summarizing a little bit of what you heard in the first episode, hopefully heard in the first episode. If we look at what's happened since COVID, let's make that the starting point. There was a whole series of unpredictable events that followed from that, and there's basically two sort of broad conclusions to take away from that. Number one of which is that at this point in time, fiscal policy in the US especially is dominating monetary policy. And monetary policy, even when it is executed, is usually done imperfectly, and it takes a while before it's transmitted to the financial system. So those are kind of two overarching conclusions that we can draw from what we've seen. And that's very important because as we go forward, the banks will be reacting to monetary policy changes primarily, but the larger picture here will be the fiscal policy and what happens, especially with the issuance of more government debt. As we got into, as COVID unfolded and so forth, there was a dash for cash, if you will, in March of 2020. And everybody was looking for cash to set aside, and there was a lot of sales of securities and so forth. There was a downturn in volumes, bank performance deteriorated, but very quickly the US government stepped in with huge fiscal stimulus. So we saw very large deposit inflows that came to the banks at almost no cost. They didn't have to go out and solicit those deposits. They just came flowing in because of programs such as
PPP.
grants. PPP for the corporations, thank you, and grants to individuals as well. So there was a huge influx of cash, which had some longer term impacts on the banks. It was quite a while, we saw inflation then start to pick up as a result of that fiscal stimulus. And the Fed was slow to react to that because it basically thought that this was transient, and there was a lot of discussion back and forth about whether or not this was permanent or transient. And a lot of it was supply chain driven, and the conventional wisdom about monetary policy is that you can only impact demand by raising interest rates. You can't affect supply. So in some respects, you can perhaps justify what the Fed did or didn't do. But that is an open question. And, some of the estimates I've seen is that perhaps 70% of the inflation that we saw in the U.S. was driven by supply chain. But that's subject to debate, and I'm sure we'll be debating that for decades to come. What the banks then saw, as I said, was a surplus of deposits initially. And that kept going. And if you look at the deposit flows since then, they continued to ratchet up steadily. And that's even with the increase in rates and some money being diverted into things like money market funds that had higher yields. Now, having said that, another big factor here is the fact that the mix of deposits changed. We saw money run out of or move out of deposit accounts, basic checking accounts, and move into time deposits and things like that, which then ultimately drove up the cost of funds to a level somewhere around 2.5, 2.6%. And deposit betas also rose. The last number I saw was around 0.6. Along the way, the yield curve managed to invert and still remains largely inverted. We have seen the spread between the 10-year and the 2-year, which a lot of people follow, is basically flat at this point in time. But the key rate or the key spread for banks is really the 5-year and 3-month. And that right as of Friday was at minus 88 basis points. So that's still inverted and will have an impact going forward, obviously on rates. Another thing that happened along the way was the collapse of Silicon Valley Bank, from which we can take many lessons. And I'm going to quickly run through some of what we saw with Silicon Valley, because it's appropriate to other banks as well, and then I'll generalize some of the points. I'd say first and foremost, one of the problems at Silicon Valley was poor governance. That set the stage. They really did not have an asset and liability management process. They had no chief risk officer for a couple of years. It was just bad governance. And so the CEO and the CFO were able to kind of do what they felt they needed to do in order to drive their net interest margin and bank performance overall. They had a huge influx of deposits, largely from the VC industry. So there's a large concentration in those deposits. These are people that knew each other, did business with each other, and that concentration, again, helped set the stage for their future problems. They had a very limited loan portfolio because VCs tend to focus on equity, not on debt. There was some VC debt on their balance sheet. There were also some warrants that they owned in various portfolio companies, but by and large, there was very little loan activity, so most of their balance sheet on the asset side was in securities. And so that basically created the opportunity for a duration mismatch. One of the things I found interesting was that at one point, they did try to hedge. In late 21, they were hedged as much as 12% of their securities portfolio, but then at the end of 22, I think it was, they sold off the hedge in order to take profits and boost their performance for the end of 22. What precipitated the runoff was the news that they were going to recapitalize the firm. Goldman Sachs had put together a deal for them, or a transaction that they were proposing, that would enable them to recap the firm and write off the losses that they had in the securities portfolio. But once that leaked out, then a very small, tight-knit, well-informed community of VCs then headed for the exits. And that was the end of the story. So what does that mean for other banks? Well, with other banks, we saw also an increased duration mismatch. With the deposit inflows that they realized and relatively soft loan demand, they had no choice but to go out and buy securities with the surplus cash that they had in hand. And they went long in order to capture higher yields. And most of their purchases were mortgage-backed securities. They did purchase some treasury securities and so forth, but the portfolios were concentrated in mortgage-backs. Along the way, in order to manage their performance, a number of banks then moved a lot of those securities from available for sale to hold to maturity. The estimates that I saw were about 900 billion worth of assets that moved from HTM to, or excuse me, from AFS to HTM. And as a result, a couple of academics, or 3 academic studies that I came across, estimated that at peak, asset values on bank balance sheets had dropped somewhere between 1.6 to 2.2 trillion dollars on total assets of about 22 trillion for the industry. So we're talking about a pretty sizable number. Some banks were doing hedging. At one point, 6% of securities portfolios were hedged. Mostly these were the large banks, not the smaller banks. Banks that were, or some of the regional banks that were hedging, for instance, were doing so as they took on corporate loans, but they weren't doing portfolio-wide hedging. One of the reasons that a lot of these banks don't do, or one of the reasons that these banks claim that they didn't do the hedging, is because of the accounting rules were too hard to follow. And we're going to come back to that. And I think Ethan has some comments to add to that. Along the way, the unrealized losses on securities portfolios rose up to close to 900 billion. The last numbers that I believe Ethan has and I've seen put those unrealized losses at about 500 billion, 300 billion, which set with the big banks, and 200 billion with smaller banks. The unrealized losses on loan portfolios are a TBD. I was in preparation for this, I was trying to get some numbers, but there's nothing in the public domain that I felt was reliable that I could share with you. So what we're looking at then with the banks is that they're facing a very different world. There's a lot of economic uncertainty about what's going to happen going forward. The balance sheets are in, for many banks, in a state of, let's say, disrepair. I don't mean to say that we're going to have a huge number of bank failures or collapses or anything like that. I don't think we're on the verge of calamity, so I want to be very careful that I don't paint too bleak a picture. But the fact of the matter is that there's a number of challenges in facing a large number of these banks. And so we start with the uncertainty about economic conditions. And what do I mean by that? Well, there's a possibility that inflation could return. The Fed obviously dropped the short-term rates by 50 basis points, anticipating that inflation would not. But as we look at things like wage rates and increases in the cost of services here in the United States, those are still elevated and could move upward. The employment outlook shortly after the Fed raised the rate looked a lot better than anybody expected, and we'll see where that goes. Obviously, if it continues to improve, that could turn into an inflationary pressure with higher wage rates. GDP growth has also been positive. The last number I saw out of the Atlanta Fed is a 2.9% projected increase for this year. Loan growth, on the other hand, remains slow. The latest SLOOS survey indicates very low loan growth and expectation of low loan growth going forward. Most of the loan growth that is occurring is simply for liquidity or cash purposes. There's not much activity in the way of building new plant or buying equipment or M&A activity and so forth. Now, some of the bankers are projecting more M&A activity next year, but I'd say that's an open question. There's also likely to be a lot more volatility in the bond markets as the banks have moved to longer duration securities, and they still have to figure out what to do there. If the government, the government will have to at some point in time issue more securities, and the expectation is that as they issue more debt, that will be longer term debt, therefore longer duration, and therefore likely to be higher volatility. So we have to be very mindful of that. Could we have higher interest rates going forward? Under what I've just described, the answer is yes, but who knows exactly where they might go. I've seen estimates of terminal rates as low as 2.75%, but going all the way up to 4% this morning. One of the big asset managers is talking about a 10-year at 5% going forward, which would be a considerable increase above where it is today. One of the challenges that the banks face because of the position that they're in is liquidity risk. I think there's some uncertainty about the stability of the deposit base that they have. There's a possibility that even in the face of declining rates, that money market funds could try to keep rates higher, and in order to keep deposits or attract more deposits from the banks. So I think that's an open question as to the stability of the deposit bases at the banks. And so some customers who are more yield seeking could be searching around for alternatives as the rates come down, something that would be higher yield. Don't know that that will be a fact, but that's something that has to be considered in any decision making. The other challenge that the banks face is because of the unrealized losses in their securities portfolios and in their loan portfolios, although we can't properly estimate those. They are in a position where they can't sell off securities without taking losses. They'd have to crystallize the potential losses on their balance sheets. And a lot of them right now are reluctant to do so in order to help keep their net interest margins up. Another thing to keep in mind here that we haven't talked about, most of the conversation has been in the last episode was around liquidity and interest rate risk, but one thing we have to keep in mind is that we're probably in the later stages of the credit cycle. And we are seeing some indications of rising delinquencies. Net charge-offs are rising amongst the banks. If we look at lower rated and high yield securities, default rates are now at 17%, although you have to be careful how one interprets these numbers because a lot of the default rates are simply indications of refinancings and changes in terms of existing loans. So that can be a little bit of a misleading number.
I got to step in here. Right. I would dispute I think it's really important to emphasize that through the earnings cycle so far and all the conference calls that the U.S. banks have had with the analyst community, they have continued to report solid asset quality numbers. And even with the deterioration that we've seen, have gone no further than just describing it as returning to normalcy, whatever that word actually means. So, I think it's important because last week when we were talking, we talked about this time is different. And this is a very fundamental difference with today versus prior cycles. I just wanted to interject that point. I know we'll talk about other things, but.
Yeah, no, I agree with that. I don't mean, again, this is another one of those signals that is not necessarily dark and predictive of major failures or anything like that. I'm simply saying that there are some signals that we are in the later stages of the credit cycle, and that, that's not to say that the banks are all going to start reporting great large losses in their lending portfolios, but there's some indications that there will be some pressures, and we are in the later stages of the credit cycle.
Again, also, I think we need to emphasize that IFRS 9 and CECL have fundamentally changed the way we think about credit cycles and the recognition of those cycles in reported earnings and in capital.
Yep, agreed. So as we look forward, one of the things that I think is one of the points I'd like to make is that if we look at risk premia, whether it's related to the yield curve or to credit, the numbers are are low by historical standards. And if we look at the interest rate or yield curve, we can it is still basically inverted. So there's no term premia for being at 5 years, as it were. And in the case of loans, and I understand what you're saying, Ethan, but again, there are some indications that things are, let's say, different. Corporate bond spread for investment grade loans right now is at 80, or corporate bonds is at 85 basis points, which is low. And spreads on high yield corporate bonds are also low at 280 basis points. Usually those premiums are much higher. And we're seeing
a
also
reflection of the fact that no matter how much we've been predicting the end of the world or just credit bumps or some sort of something called a credit cycle like we've seen in the past, we've actually seen no evidence of that.
100%, absolutely.
right.
I know, Ethan, you're looking
Yep.
forward to a good argument, but the point is,
yeah,
the point is, the U.S. economy is going from strength to strength. It defies expectation, even from the doomsayers. Forget the soft landing. Where's the landing? And we're getting rates cutting now, which is why I originally, if you'd asked me 2-3 months ago what the bottom of the cycle was, I would have said maybe 3%. Will it be as low as that? There's no reason to cut. Why would you cut next month or even the next quarter when unemployment is at 4% and not going up, and the GDP per person is what did I read in the Economist?
The reason for cutting, I would say
there's one statistic that people might not be aware of. I read it in The Economist last week. The poorest state in the US, the poorest out of the 50, is Mississippi. The average earnings per worker, the average in Mississippi, is higher than the average earnings in Britain, in a number of European countries, all over the world. That's the poorest state. That's why the 85 basis point spread for corporate credit, it looks like historically low. You want my suggestion for the next 12 months? It's going to stay historically low because I don't see any sign of the economy slowing down. Back to you guys.
Well, and that's right. And we're seeing competition. If we look, for instance, at corporate bond market, and if we look at direct lending as an example, rates, according to BlackRock, are actually decreasing in corporate lending. So this is not exactly, this is a sign of competition. There's plenty of cash out there to fund lending activities. So if loan demand picks up, there's still plenty of cash. And so this is not by any means an unfavorable assessment of where we are in the marketplace. It's, as Murad said, we're going from strength to strength. But we are seeing some unusual signs, and that's all I'm trying to point out. So having said that, what's likely to happen for banks going forward? And so now this is the point at which I want to turn this over to questions, and I've got 5 areas or 5 questions that I want to answer with the rest of the time that we have available. Number 1 is quality of governance and what needs to be done to improve governance at the banks. Number 2, what do the banks need to do to manage interest rate risk? Number 3, what do they need to do to improve their liquidity situation? Number 4, to what extent do they need to recapitalize and how practical is that? And then number 5, what, if any, solutions does M&A offer to banks? And we have to take into account that a lot of these banks are privately held. Understand that most 80% of the banks in the United States are privately held, not publicly listed. So there's differences according to that. So what I'd like to do is to kick off the conversation by talking about governance and specifically the role of the ALCO, transparency both publicly and internally within banks and what they should be doing going forward. And with that, Murat, I turn it over to you.
Well, subject very dear to my heart. Of course, you knew that in advance. The role of the Asset Liability Committee, and I've been talking about this for gosh, to 25 years now, and if not longer. And it's something. What is the role of the ALCO? I always think whatever country one is in, it's the committee that has executive authority, delegated executive authority over the balance sheet. The objective, the responsibility, the accountability of the ALCO is to ensure a long-term, robust and viable balance sheet, so capital and liquidity. Of course, where is the real authority in any institution held? Well, in the board of directors and then the executive committee. If the ALCO, as the forum that manages the balance sheet, doesn't have requisite genuine executive authority, even assuming it's on top of the situation, let's assume that all the banks that have failed in 2007 or 8 or 9 or 23, or indeed going back an earlier era, assuming, it may be a strong assumption, I don't want to talk about that but let's assuming ALCO wasn't of it and they were aware of the problems being built up in the balance sheet and customer origination, whether it's capital or liquidity or both. Assuming they were aware of it, if they don't have authority to do something about it, then the governance is failing. And I think that, for me, suggests that we need to give ALCOs in banks genuine delegated authority to manage the balance sheet, such that we don't get a kind of RBS or Citibank situation. I could name a few others. KBC Bank was one, but that's less well known around the world. In 2008, or indeed what we observed in 2023. Governance, the board is responsible for everything to do with the bank. That's universal in any country, but the day-to-day running of the balance sheet is delegated to the ALCO, but we need to give the ALCO genuine authority so they do actually own and can manage the balance sheet so it stays long-term viable. So that's my suggestion.
Don't we also, I'm sorry, can I just
No, I'm finished, Ethan. Over to you, sir.
I can't help myself. Don't we also struggle, doesn't the board, and you tell me, doesn't the board also struggle with just the quality of the information that you're actually getting about ALCO? I mean, isn't the fundamental struggle that banks are dealing with right now is that the tools, even the Fed, in terms of how it measures the economy, the basic metrics that we've used are bopping around all over the place. I mean, the volatility and the revisions in the economic numbers alone are just completely confusing. I mean, you're having unemployment fall of the employment pace suddenly falling off, and then all of a sudden it rebounding very strongly. You have a GDP that's supposed to fall off, and then it gets revised up. How does anybody really measure what liquidity and my interest rate risk issues are if you have such a volatile interest rate environment as you have?
Information is everything. The MI, management information that the board receives. The short answer to your question, Ethan, is yes. The information, yes, it is important what they receive. They've got to receive information about the balance sheet, both the current state and assumptions-based forecasts, a forward-looking view, in a way that is accessible. Board, if you think about board directors in any country, the average board director, they're not going to read a 100-page document with full of charts and numbers and tables and graphs on balance sheet metrics. They need accessible, up to the minute, forward-looking summary data on the state of the balance sheet. So that is a challenge, absolutely, and that's a challenge for the executive to meet. Let's get the information to the board that enables them to A, be aware of the state of affairs, and B, do something about it. I would summarize it in this way. If I'm talking to a board director, the question I would ask him is, are you aware of the sensitivity of your balance sheet? And when I speak of balance sheet, I mean capital and liquidity. To a lesser extent market risk, but essentially it's capital and liquidity. Are you aware of the sensitivity of your capital and liquidity position to unexpected changes in external factors like GDP, interest rates, unemployment, inflation? If the answer to that is, yeah, absolutely, I'm comfortable with it. If X happens, I'm all right, then great, the MI is in a good state. If the answer is, well, I'll be honest with you, I wouldn't say this at a board meeting, but I'm not quite sure. If that's the answer, then the information to them is an issue and it needs to be addressed. And that doesn't matter whether you're the largest bank in the world or the smallest, that is the same question for every bank, at every bank.
Agreed.
Well, in terms of the quality of information, I mean, part of it is external data, Ethan, that you're talking about. And you reference things like the employment rates and growth of GDP and so forth, but some of it's also the quality of the internal information, is
Well,
it
I
not?
mean, like we have internal information. I know what my deposits are. Silicon Valley would have said, I know who my depositors are. I even talked to them. And clearly they didn't know who the depositors were. So, I mean, yeah. And it's not just about governance. Governance is just ultimately about checking off a box. Uh, it also requires good people. Like those are hard to find all the time. You
Yep,
keep
Right.
fair enough.
encountering people who,
We
you know,
we can't fix if the problem is you say to someone, "Are you aware of it?" and they say yes, whether it's deposits or anything, and it turns out actually they aren't aware of it. Well, that's a very tough. How does one fix that? That boils down to people. That's a tough fix. If someone says to you, "Yeah, I'm good with it. I understand this. I'm cool," but it turns out that actually they're not. They don't really understand deposit behavior or what the rate move means for their capital position. If they don't really understand it, how does anyone fix that? How can we fix that? If they say, are they deluding themselves or they're just deluding you? I don't know.
well, I
Right.
just, I'm saying, I think that what seemed like a normal metric before, it's like blood pressure. You read this all the time. It's like every once in a while they revise, like, oh, your blood pressure was this. And now all of a sudden it's like, well, no, the doctors are saying you could actually have a higher blood pressure. It doesn't mean you have high blood pressure. I you know, I was just telling this to, I was meeting with a credit union board this past weekend, and I made the same point. I said, one of the things that's gone on in terms of my liquidity metrics, I mean, for looking at financial institutions, one of the things that's changed has been that there's been this surge of liquidity of M2 into the U.S. into the financial system, and also elsewhere. I mean, the UK and the ECB all practiced some form of balance sheet expansion of their central banks that added a lot of liquidity in a surge and fiscal policy that added a lot of liquidity suddenly into the coffers of most depositors, and that's never happened before. So, or at least not in modern times. So we're still trying to figure out what the ramifications of that are, but I don't think that the ripple effect has actually been spent yet. I think it's still reverberating around the system in economic numbers, in financial statistics of how I measure strong liquidity or how I measure my interest rate risk. What would you have said 2 months ago, a month ago, about the possibilities of a 50 basis point cut by the Fed on November 7th? 1 month ago, the betting was pretty high for 50 basis points. Now you can't find anybody in the room who says it. So, like, how do you measure, how do you map out, how do you even plan interest rate risk planning when you can't even figure out anything about the direction?
In fact, that's very related to your second question, is it not, Mr. Abraham? Did you not? That was your second question about RB. Now, that's a really good point. Now you're asking me, we're banks. We're talking about banks here. We're not talking about hedge funds or VC outfits or private equity or fund managers. We're talking about banks. Now, precisely because we don't know, not for certain, there's no certainty, right? Other than death and taxes, right? So we don't know which direction it's going to go or what the magnitude will be. Surely we should be originating customer product on both sides of the balance sheet that immunizes, to use the fund manager's expression, the impact of rate moves as much as possible. So ideally I could just have floating 3-month, I'm out of date, it's not LIBOR anymore, SOFR on both sides of the balance sheet, right, or SONIA, what have you, and then it wouldn't matter. Of course, I want to do fixed rate lending or fixed rate deposit taking because that's what customer wants. So I then use either organic or derivative or both product to get that immunized state. Now, surely I should have to have as minimum as exposure to changes in rates as I can, as possible. Now, it's not possible to completely immunize that, even in theory, let alone practice, I would suggest. But if I aim towards that, then I should be less concerned about the magnitude or the timing or the direction of rates, because I have minimized the impact of the rate change. That's what a bank should be doing. Because you're right, a couple of months ago it was oh yes, 50 basis points in November. Now no one's taking that bet. I mean, when is there a cut again this year? I would suggest not. I don't know what you think, Ethan. I
Oh,
mean,
no, I think if you look at the CME's Fed Funds Monitor thing, it's pretty much 25 basis points seems to be the consensus now in the
okay,
market.
Yeah.
okay.
I
So
mean, you
I'm
can
slightly,
disagree with that. I mean, I know that people are gonna make the case, oh, well, why are they cutting? We have a robust economy. I made that point before, but I've come to the view that the Fed is cutting not because of inflation and its impact. In fact, I don't think anything the Fed has done has had any impact on inflation, whether it's stoked it or actually cut it back. I think the
Well-
reason why the Fed needs to cut is because it has come to the conclusion that from a neutral interest rate, real interest rate perspective, they are about 3 points too high. And the only question is, what is the pace of that reduction? Not because we need it, but because you can't have a monetary policy always stuck in restrictive mode
Yeah.
and still call it a monetary policy.
that's a really good point. But how
Well,
restrictive
there's-
is it? Sorry, Tom. I'm late.
Yeah.
How restrictive is it if we're seeing no increase in unemployment? I'm seeing I'm seeing the economy powering from strength to
That's
strength.
fine.
This is
That's
the point.
fine. So if you had the strength of those convictions, Mr. Fed, you would raise the Fed funds rate to 10%. I mean,
Well, no.
take the sledgehammer and go ahead and smash the economy. But they don't have a political mandate, no matter how much they
But they
parade
wouldn't
around
want to
as
do that
being
anyway.
independent to do
They
that.
wouldn't want to. They wouldn't want to do that anyway.
Absolutely.
Tom, over to you. Back to you, sir.
No, that's fine. There's a couple of key points, I think, in this discussion. Number one of which is, and Murat, I want to go back to a point you made just briefly, which is that if you normally the conventional wisdom is that deposits are a natural hedge um, to loan activity. There's
On an E
theoretically,
standpoint. Right.
I'm sorry,
Yeah,
there's
on
a
an
natural.
If it's
Yeah.
fixed term against fixed term, yes, on an Eve standpoint, correct, yes.
Well, yeah, if rates are relatively stable and economic conditions are relatively stable and so forth, but we're not in that situation. So that conventional wisdom is basically out the window. So there's got to be some different strategy going forward. You can't just assume that there's a natural hedge there. And you were talking about trying to immunize the portfolio, if you will, by being variable rated on both sides.
Yeah,
Well,
but I'm sorry, Tom, can I jump in also, Murat? I wanted to jump in one more point that was also really important you made, and I wanted to respond to that, is I'm the board or I'm management, whatever I am. As a bank, I intermediate risk. That's true. I'm supposed to, and I could be neutral, but I'm also something else. I have a responsibility to shareholders to return shareholder value. And that means that as management of the bank or as the ALCO of the bank, I can't really be neutral. I have to manage interest rate risk. I have to manage it to a degree that I'm not undertaking less than I should be taking in terms of risk for the capital that I'm getting to manage, to invest, and I'm not taking excessive. The struggle, I think, for most banks today, most treasurers of banks I speak to, is figuring out exactly where that line is because it's moving all over the place.
Yes,
Right.
now that requires you. Look, I'm an ex-treasurer myself, front office treasurer as well as middle office with a P&L target. I was doing money markets at Hawkervet Securities when I had hair on my head. It's a long time ago. Now, the thing is, you're quite right. You're quite right. You're quite right. Obviously, the bank will take some view. I want to maximize my return on capital while still maintaining as minimum risk as possible. That's the name of the game. So we will take a view. We all will. We all will have a view. When the base rate was at 0, we all had a view that the next move was going to be up, right? And when the top got to 5.25 or X or whatever it was, 5% or 3.75 in the Eurozone, we all had a view that, well, the next move will be down. We just don't want to put the timing on it. So we take a view and we structure the balance sheet accordingly. That's why you're quite right. We have to generate shareholder value. The premise is whatever my average funding rate is, X%, I will lend at a rate higher than X%. And if that spread delivers me 12% return on capital, I'm doing okay. We want to optimize a balance sheet by maximize that NII. So I will take a view, but I don't want to have an earning sensitivity that means if the rate cut, or the rate move does come too soon or too late, or is not 25, it's 75, I end up with having a negative impact on my NII. That's what I meant by immunizing. I don't mean we don't take risk. Absolutely, we want to maximize that NII position, but we don't want, how shall I put it, a sensitivity to the impact of the rate move that is painful for me. Let's put it that way. Okay, and that requires metrics. I want to analyze my sensitivity so I can see if there's a 25 or a 100 basis point move, what the impact is. And of course, we need to go beyond the regulator minimums for that, because the rate cut doesn't result in a parallel shift in the yield curve. Everybody knows this. When the Fed or any central bank moves rates by any amount, the curve moves in response. And it's not parallel. It moves at different amounts along the term structure. So we want to be aware of what that means for our net interest income. That's what I mean by immunizing. I didn't mean literally zero risk. That's not possible. We take a view, but we want to understand what the sensitivity of our balance sheet is. If that sensitivity is beyond my appetite, then I should do something about it. I'm not going to deny that. Look, we all have treasury backgrounds here. We're not going to deny that. Yes, we take a view and we position the balance sheet accordingly, in line with what we can wear. You know, what our appetite is. So I completely agree with you. We shouldn't forget the reality of banking. It is to intermediate risk, and it is to hold. See, we're not brokers. We manage the risk on our balance sheet. So we're going to pass fund, we're going to take in short-term deposits and make long-term loans, and we're going to manage the resulting risk. It's got to be something that we understand and is within our appetite.
All right, Tom, you could talk.
Well, I would know.
He interrupts both of us. He's always the man in charge.
You stunned me with that toss of the ball. But what I want to come back to is understand that a lot of these banks are relatively small. There's a limited amount of expertise, a limited amount of data, a limited amount of technical capability and so forth. So how do they intake this information and digest it and actually then make decisions? It's really difficult. If you look at board composition, I don't want to sound like one of the regulators right now, but there's a lot of criticism about the composition of bank boards and whether or not there's sufficient expertise to guide management and understand when there's an exception that is potentially an existential threat to the bank. So what do we do about that? Is there some way forward, something that these banks can do in the here and the now to handle this ambiguity, if you will, or uncertainty? I left everybody speechless.
I think that's our colleague's call here.
I was going to hand that to you, Ethan. Tom, you've done something exceptional. You've asked a question that neither of us wants. Normally, both of us are fighting for airtime here on this one. You've asked a question neither of us want. It is a perennial problem in any country. In every country, it's a perennial problem, and because there is this, let's call it, this Anglo-Saxon concept, but it's replicated around the world, where you have a board who are standoff, they're not full-time, and you've got the exec who are at the coalface managing it. That presents a governance problem. That was your first question, and obviously technical expertise at the board level is important. For one reason or another, board directors, and I've seen this in every country when I've looked at banks in any country, developed or emerging market, for one reason or another, board members don't all have banking backgrounds, for example, or even if they do have banking backgrounds, it's not necessarily in risk management or in customer origination or in understanding the balance sheet. That's just a reality, and it's universal in every country. I confess, maybe you weren't explaining this, I'm not sure. I don't have an answer to that problem. I confess I don't know how one fixes that unless there is we make it in the rule of law in any country, in a jurisdiction, a national jurisdiction, there is legislation or some regulated guidance.
That's the FDIC's trying to do that right now. They have a proposal like that. Good luck finding people who want to be on boards then. I mean, nobody.
Well,
I didn't know that about FDIC. Are they saying there needs to be some certain minimum standards every board director has to hold?
The board is going to be a co-manager That's the language. That's crazy.
Really?
No one's
Okay,
been- yeah.
forgive my ignorance.
Oh.
I wasn't aware, but that's not the rule of law just yet, right?
Well,
That's a
it
whole
was a
different
proposal.
It's a-
I hadn't seen it. It
that's
hasn't
it's a
been
proposal.
finalized,
But
It
that's
is
a
only a
whole
pro-
different. That's a whole different change in the ballgame. That's a
Exactly.
big change, and that's. I
Yeah.
mean, if the US moves forward on that, it'll be moving ahead of what. Personally, I can see a lot of value in that, at least theoretically, because then
No,
but
who
theoretically,
manages
no.
it?
Not practically. You can't find anybody who wants to belly up to the bar for that kind of civil liability. That's absurd.
E-
Not
Ethan
going to
is
happen.
Ethan is absolutely right. That's the problem. Nobody will want to serve on a board. There's not enough D&O insurance in the world to cover boards against the potential fallout from that kind of regulation.
I mean, this is how a board meeting goes. Management comes in, they show a presentation to the board that's assembled that morning, right? They just finished the coffee. They're sitting there, they finished the breakfast, there's a lunch coming up, and then maybe a golf out, who knows? And they're sitting there and the management presents a presentation. They say, this is our risk, this is where we think it is, this is where, and we want your approval for this taking this. How many people vote yay? How many people vote no? Done. Let's go. Keep moving. That's what we do.
I have to
That's
admit,
board involvement.
Mr. Heisler, that's actually not an inaccurate summary of the average board
Yeah.
meeting. I mean, I know you're partly tongue in cheek, but you're not inaccurate there. You're not.
So, I mean,
No.
what are we trying to change? And look,
Maybe that's exactly it. Maybe the culture in any country needs to change away from that approach, and maybe the FDIC approach will result in that.
Well, how about the bank examiner sits in on the board meeting and actually says something like, oh, this is our report. This is what we have. Did you see this? And just oh, no, we don't go out for the golf outing this afternoon. We're going to stay in for a discussion from our chief examiner, who's going to relay all the summary findings that they found, which of course will still be perfunctory, but at least somebody did a little bit more steps here. But I mean, if you want to move forward and but I just want to emphasize that, and we were going to talk about what we should do. I mean, right now, one of the big issues are if I still have, as Tom mentioned earlier, a 3-month, 5-year inversion, I still have opportunity to monetize the forward curve in my funding. And that's what I hear banks really talking about. It's not a lot of opportunity to do stuff on the bond side because that was a great trade 3 or 4 weeks ago.
Yeah.
But the mortgages have moved up already, so the door kind of closed.
Yeah. In fact, I think the curve is going to disinvert, isn't it, between 3 and 5? Do you not think? It's going to the 5-year will be.
That's predicated on the idea.
Well, if we
that
go
the Fed
back,
is not going to go back to 3%.
well, let me just insert a little history here because the picture's not clear. If we go back 2 months ago, when we were first talking about some of these issues, guys, that inversion was minus 170 basis points.
Mhm.
Then it went down to under 80, and now it's back up to 88. And I don't know what it's going to do, obviously.
So
over the next-
volatility.
I'm
That's
sorry?
the volatility. That's the volatility I'm talking
the
about in terms of making the
Exactly.
decisions that you're doing. But there were a lot of banks I know of that before the end of September did get out of, did do some restructuring because they had gains in their portfolio. And that's going to continue to go on. When I have gains, I'm going to take them.
Yeah.
Yep.
Yeah. Yeah.
Which means that there's more latent losses than sitting on the balance sheet.
Available for sale or HTM? Or loans?
Well, both.
Well, HTM and loans.
Because
just
I've got a
continue
couple
to
of
run off.
graphs.
Well, no. I'm recognizing the losses in my underwater balance sheet over time. That's bleeding through the net interest margin.
Yeah,
And
they're
that's
smoothing
gonna-
it out. Yeah.
But the expectation or the hope was the Fed's going to cut interest rates and many of my problems are going to go away because, the bond portfolio will look so underwater in a year or two. That's not materializing. In fact, it's going
No.
the opposite way.
Right.
As there is an expectation that, the Fed's cutting. This is almost
and
predictable.
and
We're gonna
it's
have
not
inflation.
it's not materializing because the economy is proving to be much stronger than anyone would have thought even a year
That's
ago.
right.
It's not materializing, and I personally don't think it isn't going to materialize. Not down to 1, 2, 3, below 3% base rate, Fed fund rates, because the economy, there's no reason to go below that. The economy, not from all the economic statistics, it's the economy is going from strength to strength. Whether when the base rate was at 0 or the base rate was at 525, the economy has gone from strength to strength throughout that. So there's no imperative for the Fed to cut anything below 3.5, even over the next 12 to 18 months. That's a personal view.
That's
Obviously,
a tail risk. That's what you believe is a tail risk. Whether you know whether that tail risk is 2% or more like 10 or 15% is the open question that
Of course.
says is debatable.
Of course, yes. And one would have a view. Everyone would have a view.
For example, let's say we're literally not even talking about it, and we've got not much more time left. But, we've got a potential major war in the Mideast. We've got the Ukraine-Russia thing that doesn't look any better than it was and I don't know where that's going to end up. We've got potential for some serious climate change stress. We have no idea where that's can come from, but you know what? Just like COVID was an out of the way, never would have expected it. Those are the scenarios that banks do need to prepare for. So again, my emphasis is always about from a trade standpoint, don't wait to look for things. Right now, where the market is, what do you want to do?
I completely agree. Be aware and do scenario analysis on those geopolitical type issues. But from a rates perspective, all of that would argue against rates going any higher, and they would argue rates going lower quicker. But down to 0 or 1% again, even in an extreme situation, wars, Middle East or not, I don't see it myself. If I had a 24-month view, it would have to be extremely extreme, if that makes sense, to go back down to 0 again. So we're still sitting on underwater portfolios. We have to assume rates won't go much below 3 or in base rate. So I plan accordingly, and I try and get my funding costs down as much as possible in the event that rates do go lower than I think. And that's a challenge as well. Tom, you mentioned earlier that there's a surplus of there's growing bank deposits. That's a good thing because banks will all need funding, and that will keep rates higher, which is a challenge. If I'm competing for customer deposits, both personal and corporate deposits, and I would love to see rates come down so my funding cost goes down. I don't see it. That's a real challenge, I think. We actually have something on the chat.
Questions, right?
It's not clear to me that they will come down. I'm sorry.
Just by how much? I agree. Just by how much.
Questions. I think Bobby has a question.
Given the recent events like SVB and CS bank runs, and considering the current interest rate inversion alongside depositors seeking higher yields and mortgage rates expected to remain elevated, how crucial is behavior modeling of depositors and credit risk assessment of a bank's assets in today's market? I add geopolitical tension that Ethan mentioned to the mix. So 2 issues there. How crucial is behavior modeling of deposits, customer deposits, retail and SME and large corporate, I guess, and credit risk assessment of a bank's assets? Well, I'm going to hand that back to the 2 of you. I would have thought that.
I was going to say it's more crucial. I think, that just, it seems like that. Who would disagree with that? Knowing but it's not just the behavior modeling. What you see with a lot of community banks I talk to is they literally go out and know their top 5, 6 depositors and spend time with them.
Yes.
It's like, I don't do just the commercial borrowers anymore, but I actually do the depositors too.
Yeah, absolutely. In fact, you could probably make it, you say 5, 6, you could make that 20, 30, 50. Absolutely, it's relationship management. I would behavior modeling of NMDs is a perennial issue. I don't think there is great return from having ever more sophisticated approach to that from what do you actually do with it, whether it's a simplistic assumptions-based approach or a more agent-based modeling approach. It is about understanding our customers genuinely, which is why I like your point, Ethan, about going out there and actually talking to them. So you're right. Everyone would. That's an unarguable observation from Bobby. I agree.
Yeah, the survey approach makes a lot of sense. Some of the stuff I've seen is very technical and just makes your eyes roll in the back of your head. So to me, the survey approach is far more sensible because you actually understand what people are willing to do. Have you read the
New York Fed survey of market participants lately and seen that? It's the same kinds of surveys.
Yeah.
No, but you're saying it's that's worthwhile, that has value, right? I haven't seen it.
Oh, I know, it definitely is value. I mean, they do
Right.
it on a
Yep.
quarterly
Okay.
basis. So,
Okay.
you know, you can monitor. I mean, the issue of monitoring surveys is not the answer that you give today. It's what the answer is you gave yesterday versus today.
Right.
So
Understood.
it's
Yes.
really about tracking this on a regular, ongoing basis. But they're very
Yeah.
detailed. They talk about
But you know, one can't go away from knowing your customer, which is why, you know, genuinely understanding your customer on and their expectation, you know, your expectation of their behavior is important. And I wonder if, you know, that can be modeled ultimately in an extreme stress of the kind that Ethan was talking about, because you know that if I'm a digital bank or a challenger bank and I don't have face-to-face contact, I don't go out and see them, I don't have corporate depositors, is my modeling going to be accurate? I throw that question out. I don't know.
You should
Yeah.
unmute Bobby, and he can go ahead and finish asking his questions.
Yeah, Bobby. Yeah, can we unmute Bobby? How do?
Ed, can you unmute Bobby? He can speak right up. Absolutely, good point. As we have only 3 minutes to go.
Yeah, yeah. We'll give Bobby the last.
Bobby, you have 30 seconds.
The last word.
Oh, there we go. Okay, I don't know if you can hear me, guys.
I can. Yes, absolutely.
Yeah.
Yes.
It's fantastic, by the way. Yeah, I mean, I was just thinking, you know, with the whole situation in play, banks looking to attract different kind of depositors, different mix, and so they would have set models in play, and I think they've got to change that, and that so because they're going to attract people from different backgrounds and countries, and now the border is opening, they're looking for returns quicker, and I think with the play of AI to come in and behavior modeling, I think that becomes much more exciting, and because we got fintechs and digital banking just you know scooping up quite a bit of clients. I think this is the way for state banks to basically start responding, in my opinion.
Personally, I wouldn't disagree. I think there's a lot of, we haven't even touched the possibilities, or we're just only just understanding the possibilities that AI and agent-based modeling would present with respect to understanding customer behavior. So I personally agree with you. I don't disagree at all with that. There's a lot of future there for investors to build these, to fund these models being built by engineers and entrepreneurs.
Okay, with that.
Yeah, go on. That's it. I was just saying thank you so much, guys. Fantastic. Appreciate it.
Oh, you're very kind. Thank you. You're very welcome.
Yeah, thank you, Bobby. I want to call an end to this. We've got 1 minute to go. And what I want to remind everybody is that these episodes will be available for replay. We will also be writing up a note or article that summarizes what we've said so far. And I would also suggest that perhaps we consider a third episode to delve into a couple of these matters in more detail. So with that, I thank everyone for their attendance. I thank Murad and Ethan for their sage advice and wisdom. And with that, I bid you all adieu. Thank you.
Thank you, Mr. Aaron. Thank you, everybody. Have a good afternoon.